Good morning. Thank you, Jason. Thank you, Michael. So now that a lot of the noise and nonsense in the blockchain space has subsided, it is time for us to focus on the protocols, the applications, the platforms that got the fundamentals right, the technology and the business fundamentals, as well as the ability to generate institutional and retail-grade financial instruments. So today I want to talk to you about two such applications. One is in the financial services, structured finance space, and we're going to be talking about green goes forward. Okay. So we're going to be talking about bonds. The other use case and application is in the film industry, and accordingly we're going to be talking about James Bond. These industries are huge. They also cater and bring together a number of constituents, a lot of players involved in the processing of transactions and business. And we can see that there's so many players involved that this is right and just calling for more efficiencies, transparency, and cleanup. So the reason I brought these two applications together, and they may seem to be worlds apart, but once you put them through the digital asset lens, you realize that at the end of the day, they're pretty much the same type of application, especially in the case of these two entities, since they are looking to generate digital assets out of revenue streams. So yes, both of them, FIC and Motion Protocol, are basically looking to promise better efficiencies, transparencies, and cost savings by using and leveraging the blockchain. But at the end of the day, through very creative financial engineering, they are developing new types of financial instruments, and that's what I want to focus on today. So both applications are interested in the creation, management, and distribution of a number of digital assets. So what I want to do today is kind of just talk to you about both of them pretty quickly and see how those two organizations have been able to make strategic decisions relating to their technology and their business endeavors. So let's talk about bonds first. Bonds is huge. It's a huge market. It's over 115 trillion worldwide, both in debt and financial instruments. It is huge compared to equities. If you're talking about tens of thousands of stocks and equities, we're talking about millions of different types of bonds. Only 26% of all bonds today are traded electronically. So the whole space is quite opaque, it is scattered, and it's very illiquid. The problem with bonds also is that they're very complicated. They come with a whole series of features, calls, puts, sinks, toggles, and it's extremely difficult for anyone to make any sense of the value of different types of instruments. When you're looking to model and assess the value of a bond that is marginally complicated, you need to draw on over 100 different data points from different sources to be able to distill and to create models that's going to allow you to make decisions on purchasing and selling. This is extremely difficult, especially when you're talking about new types of instruments, and especially in the context of blockchain when you're creating and introducing tokens and other types of crypto types of digital assets. So imagine how complicated that is if you need to bring this into and impart it into a smart contract. It's almost impossible. However, the opportunity is so huge that a number of players over the last 3 years have been working diligently at creating the types of platforms that will allow players to basically build out, construct these instruments, trade them. And I recognize a number of people in this room that are trailblazers in this space. Just last week, Société Générale in France issued a $112 million bond to itself, but everyone's kind of learning, tinkering, and basically developing the types of platforms with new products, with bigger amounts of money involved, and more complexity with the various instruments that they're looking to bring in. So FIC, at the end of the day, is looking to create a platform that is going to be able to bring through these transparencies, these cost savings, and this automation in this space. And as a result, we'll be able to deliver better information, better cost savings, and better efficiency in the marketplace. Now let's talk about films just for a moment. Films is a bit different. Motion Protocol is looking to basically bring all of the film value chain on the blockchain. That implies that they need to bring in a greater number of constituents to be able to contribute and to work together and coordinate their activities. Theirs is really a totally different approach. Their strategy is truly a disruptive strategy, truly disruptive in the sense of what Clay Christensen would be talking about. They're not looking to take a bite out of the business of the big guys, but they're really going after the underserved market. And it's really fantastic to see how they're going to be doing that. They are looking to create new value for a totally different set of players in the marketplace and address some of the major issues associated with the film industry. That includes the notion of being more transparent relating to costs and revenues. So they're proposing, I guess, to convert what we call Hollywood accounting to blockchain accounting. They're also looking to create or develop or transform motion pictures into investable assets. And they're going to be doing that in many different ways. And one of the ways they're going to be doing that is by enticing consumers to basically invest and support financially the directors, the producers, the actors that they favor. So everybody loves movies. So instead of voting with Rotten Tomatoes, people are going to be able to vote with their feet, invest in these different assets, and basically also yield some benefits from it. They're also looking to address the issues around gap financing. A number of independent producers typically will lose a lot of their intellectual property rights at that very moment. And if you can create a system by which you can securitize future cash flows from the movie industry, you'll be able to basically address that gap. So let's go back now and talk about infrastructure. Both applications are built on the blockchain with an application layer. As I mentioned before, FIC is in the bond business. What they're looking to do is to basically render the transfer of money much more efficient. So they called on the Stellar blockchain. The Stellar blockchain is or was or has been built for financial institutions, for financial transactions and operations. They transfer money very quickly. They're involved in bid and ask operations. They can work with different types of currencies. And it's extremely robust. It is robust. Compliance is already embedded into the fabric of the blockchain. And they also have dealt with the issues of dealing with the conversion of fiats and cryptocurrencies. So to a certain extent, Stellar is probably the best type of application for the bond business. Motion, on the other hand, in the film industry, they're looking to bring in a number of constituents, getting the constituents to not to build, but to basically cooperate and to collaborate and to be able to transfer and communicate different types of values and assets between each one of the players. So they had to build something from scratch. They had to build something where they were able to bring all these elements together. And they've decided to use the Plasma platform, which is a side chain to the Ethereum blockchain that allows them to build something that's specific to the industry. So let's look at the applications per se. So FIC is building a white label platform for bonds. They're looking to automate the whole process associated with the creation, the management, and distribution of bonds from the inception to secondary markets. They are able to leverage a lot of the functionality made available under the Stellar blockchain, and they basically are automating the whole process from onboarding to documentation to syndication to transfers and to trading. They do that through a modular system where people can basically come in and cherry pick the elements that they want, and they're doing it in a very smart way where they basically have built a number of different layers that are layered one on top of the other, and they've actually been able to demonstrate that the transactions can actually flow efficiently between each one of these modules. Motion, on the other hand, as I mentioned, is looking to build a system where they're bringing together a number of different constituents. And there, what they decided to do was to leverage the Plasma platform and invite a number of independent platforms and service providers that are in the industry to connect to this platform through the development of decentralized applications. So at this point in time, they already have the core platform of providers that are kind of building on their own these different types of systems and can basically deliver value at different phases of the film workflow. So right now, they already have 7 different applications that are in place, and they cover issues or services ranging from tokenization, the gap financing, licensing, intellectual property attributions, payments, accounting, and legal. To also support them in this process, they've also called on COLAP, a coalition of automated licensing agreements, which is an international governing agency that helps to create or to compensate for the gap between IP law and the internet. And they've also imparted that, and also they've also created their own accounting system with basic principles that can basically allow them to flow between blockchain metrics and the film industry. So all this is very interesting, but what's really much more, I think the reason why I'm really talking about these 2 applications is the fact that both of them are looking to create very unique types of financial instruments. Through creative engineering, they've been able to kind of tap into the flow of revenue and rights that are going through the pipes that they're building out. So to illustrate what they're doing, especially FIC has developed a new concept called expected cash flows, ECFs. And ECFs is really a different way of being able to capture dynamically different tranches of interest at different points in time in the life cycle of an asset. To illustrate exactly how this works, I just wanted to kind of just use this illustration. Traditionally, when you're talking about securitization, you will have aggregators will bring in a pool of loans and debt. Once they have this bucket of debt, they kind of reorganize them based on the type of risk scenarios. They pool them together parse them out and sell them out to a number of investors. So essentially, they're basically securitizing the whole pool of loans and that they have acquired. What ECFs, what FIC is proposing with ECFs is really two things. They are looking to decouple the interest and the capital, as well as to break down the relationship between the borrower and the asset. So at the end of the day, what you end up with is a series of strings of cash that an investor can basically look at, focus on, and choose on the fly and dynamically. So basically, through decoupling and stripping, you are basically, as an investor, able to match and find and acquire an exact string of revenue that you can use inside of your portfolio. So it's really portfolio construction that allows you to focus more on the digital assets than on the collection of borrowers' risk profiles. So this is extremely interesting, and I think that this corporate engineering is starting to find its way into these more mature blockchain offerings. In that context, I also wanted to share with you some insights that I have gleaned from the Fintech ecosystem and from the different business units at Morningstar, namely the work that we're doing in credit ratings, our work in our quant team, as well as the work being done at PitchBook. And I want to share that with you because and I assume that most of you in the room are looking to create pathways to financial markets, I think there are a number of considerations that you need to take into account that deal with certain types of new trends and insights that I want to share with you. So very quickly, I want to talk to you about direct beta. There are a number of fintechs that are proposing that ETFs, and even for that matter, that ETFs are dead, or even that, for that matter, that asset managers are dead. They are using fundamental technologies, new frontier technologies, I should say, to be able to build out platforms that are basically empowering investors to become their own portfolio manager. Through direct dynamic indexing, an investor can basically set out a profile that is predicated or basically reduced to a personal index. And this index is really built out with the ability to layer different types of choices relating to values, to benchmarks, to inclusions and exclusions. So, I don't want guns, or I don't want certain types of assets, inclusions, certain types of factor tilts, and tax optimization needs. Okay? Once you have all that together, you can have your own personal index. And as a result of that, you end up with a situation where your advisors can basically be streaming to you sets of recommendations for different types of investments. So as you develop these indexes and put them in place, you're basically seeing your own portfolio situation being rebalanced in real time and on the fly. So really, these advisors are really streaming these investment strategies to the investor. So we're kind of going from the ETFs and the mutual funds, which sound like CD-ROMs, using CD-ROMs, to a world where information like movies or music is being streamed to you. So this is extremely important for all of us in this room, because with these new indexes, you'll be able to create new types of sleeves that's going to allow you to be able to bring in some of these new types of financial instruments. And these will be some of the types of strategies that we're starting to see starting to creep into the fabric of the wealth management space. I also want to talk to you about the private-public convergence. We're seeing a lot of work being happening in between, just in that gap between private and public. In fact, we're seeing a lot of people in this room that are spending time developing new types of exchanges, markets, products, and services around and catering to that opportunity. At Morningstar, we're working closely with PitchBook, and we are working at creating new types of models and indexes that are predicated or honed from the public space. And we're using these public space metrics and imparting them into the private setting. So some of these are, one is called equities comparables. And these are already imparted into our PitchBook listings. And this also becomes important because as you are building out your private offerings, you need to realize to what extent the new models and the new guides have been honed from the learnings and teachings in the public sector. And that is also being imparted into a number of our research, into our programs, and is being consumed by advisors, VCs, PEs, and a number of redistributors. So a lot of that information relating to comparables as well as to granular models are also finding their way into the private sector. Robo 2.0. The essence of fintechs for the longest time has always been to eliminate friction or to eliminate barriers. But what we're seeing more and more in the space is that a number of them have gone too far. And now they're basically realizing that they need to bring back the human in the loop and actually slow down investors when they're going through their decision process. And this is important for all of us because we're looking to develop blockchain applications where we're automating processes and we're delivering results in a very fast and automated way. Whereas we're learning that the consumer cannot handle that kind of speed. So that's something else that we need to take into account and be conscious of. Credit ratings, finally, credit ratings. We have our creative ratings agency has already been entertaining a number of conversations with a number of blockchain-inspired enterprises. And we're very excited by these developments. We believe that credit ratings will be using a lot of the learnings from the blockchain world. I think that that blockchain can help with communication, interoperability, transparency, and cost savings. We believe that credit ratings can basically play the role of a risk oracle, where they can very quickly carry out analysis and modeling automatically and re-impart into these platforms the feedback and the information that they're looking for. We're also very excited by the idea that programmable money and programmable information will also be a mainstay in the credit ratings business. We still have a lot of work to do. There's still a lot of uncertainty and questions relating to the application of blockchain to our business, but we're already working in this regard, and we've been entertaining a number of conversations with a lot of you. Last two things, very quickly, crypto index. We spent several months looking at how we could develop a crypto index, how we could use the lessons learned from working at developing indexes and applying that to the crypto space. So we've basically transformed and played around with our methodologies. And so all of them are ready, but we're very disappointed by the lack of persistent and consistent and quality data in this space. So Our crypto index strategy has been put on the shelf until we feel comfortable with the quality data that can be imparted into the application. So that's kind of a warning for everyone. But we are looking for data. And finally, if you ask the more hardcore analysts at Morningstar, they will tell you that they don't believe that cryptos really qualifies as an asset class per se. As a result, they're kind of pushed into into a category of alternatives. And as a result of that, they have not been able to acquire the position of the market, the reputation, or the standing that they need to be properly accepted by wealth managers and advisors in the marketplace. So again, a lot of work needs to be done to elevate the standing of a number of the products that are coming out of blockchains. So that's all I have for you today. So to go back to FIC and to Motion, we don't really know if they're going to be successful or not. We know that they cannot escape the rules and the best practices associated with disruptive technologies, good fundamental business decision making, as well as platform economics. But I think that they're going to do well. We're very excited by the role that Morningstar can play into this process. And we believe that there's a lot of work to be done, and we are quite open to working with any of you in that context. We did, I think, learn that at the end of the day, blockchain might not change the world, but I do sincerely believe that the people in this room will. So thank you very much.